Hi, everybody. Welcome to a more technical topic here at the Canadian Financial Summit. We're talking today about selling your company shares versus assets. We're going to dive into the biggest financial decision that a business owner can face selling their company. So should you sell the shares? Should you sell the assets? What are the mistakes you should try to avoid along the way? Guiding us, I'm joined today by financial planning expert Nancy Grouni. She's a certified financial planner who works with a lot of incorporated business owner clients, developing and maintaining long-term financial plans and helping them to prepare for retirement. Sometimes that involves selling a business. Nancy, thanks for being here.
Thanks so much, Jason. I think this is such an important conversation because selling a business, after all, it really shouldn't just be transactional. It's a life event. After all, when you think about it, it impacts everything from retirement to estate planning, family wealth transfer, and of course, taxes. So planning ahead really matters.
Creeps up on you too, as does retirement. So we're going to get into it. And first off, I just wanted to clarify, what's the difference between an asset sale versus a share sale for a business owner who's incorporated and has a corporation?
Right. I think it's such an important distinction to make. So in an asset sale, really what you're doing is selling specific assets of the business, be it the equipment, the inventory, customer lists, or goodwill. The buyer is typically avoiding most liabilities. And from a tax perspective, the corporation pays capital gains on the tax proceeds. And then if you distribute those after-tax proceeds to yourself personally, that's where you might then get into a second layer of personal tax to draw out those funds. So obviously, it's important to consider whether you need to take the money out of the company in that kind of a situation, how soon, what the timing looks like, and what those details are. Like, what are the personal tax implications? Because I do find that sometimes those are overlooked. In a share sale, on the other hand, what you're really doing is you're selling the actual shares of your corporation. So it's pretty much like the buyer is basically just stepping into your shoes and taking over everything from your assets, liabilities, employees, you name it. So from a seller's perspective, though, it's often more tax efficient, especially if your shares end up qualifying for something called the lifetime capital gains exemption, known as LCGE.
So with an asset sale, the corporation is selling stuff and the corporation gets the money. In a share sale, the individual is selling shares and the individual personally gets the money. That lifetime capital gains exemption, I think, is really important for business owners who can qualify. And, great segue into my next question. So can you explain the LCGE, the lifetime capital gains exemption? What is it? How does it work?
Absolutely happy to. So the LCGE allows Canadian business owners to shelter up to $1.25 million, and that's a 2025 number. That figure actually gets indexed annually, and it's really the capital gain that's being sheltered from tax when they sell their own shares of a qualified small business corporation, and the acronym there is QSBC. Just a side point, so for farm and fishing property, the exemption's actually the same. So what this actually means is that if your business ends up qualifying and you sell for, say, $1 million in gains, you could potentially pay absolutely no tax on that portion, which is pretty incredible. Honestly, it is one of the most powerful wealth building tools for entrepreneurs. And on top of that, there are actually ways to potentially multiply your capital gains exemption and use those $1.25 million exemptions from, for other family members as well.
No, definitely a great opportunity. I think the limit last year was 960 or 980 or something like that. So very significant increase from 2024 to 2025. And multiplying and being able to use it for additional family members can be really powerful, like you mentioned.
Especially with appropriate planning in place, right? I think especially if you're going to be multiplying the exemption, then absolutely.
Can't be last minute.
No,
right?
exactly. Yeah.
And so what does it take then for shares? You mentioned a couple acronyms. The LCGE is the lifetime capital gains exemption that a business owner may be able to qualify if their business is a qualified small business corporation, a QSBC. So what does it take for a corporation to qualify as a QSBC?
So there's three main criteria actually. Number one would be the small business corporation test. And that's really the test that says at the time of sale, at least 90% of the company's assets must be used in an active business in Canada. So what that means is that passive investments, like whether it's a big stock portfolio inside the company or real estate that's being held inside the company, can actually potentially disqualify it. Number two would be the holding period test. And this is the test that says you have to have owned the shares, generally speaking, for at least 24 months before the sale. The third test is an ownership test. So during those, or rather a throughout ownership test. So during those 24 months, more than 50% of the company's assets must have been used in an active business. So more than 50% for the previous 24 months, but 90% at the time of sale.
Got it.
So if you have excess cash or investments in the company, which is quite possible, then a planner or a tax advisor or both may recommend what's called a purification strategy to transfer or move those assets out well before the sale happens.
So be careful about building up investments inside a corporation you might sell. And that holding period test is important. You mentioned potentially multiplying that lifetime capital gains exemption with other family members. You can't scramble the last minute and transfer shares to family members. You need to plan ahead. You need to have growth, and you need to have them owning shares for at least 24 months.
It's interesting. Like I've had on more than one occasion clients who have said to me, you know what, we didn't think that we would end up selling. So there was no planning done whatsoever. And unfortunately, they missed out on the lifetime capital gains exemption, which represented, as we've discussed, hundreds of thousands of dollars in tax savings. So it's such a shame for that to happen. So I would say that even if a business owner doesn't think that they'll be able to sell their business, that it's still a worthwhile conversation to have.
I guess you could even run into a situation where a business owner dies
Right?
and their company could have qualified for the lifetime capital gains exemption, and there's a big tax bill or something on death.
That
So
didn't have to be there. Right?
plan ahead.
For sure.
And so then from a buyer's perspective, someone who's courting you to buy your company, why might they prefer an asset sale over a share sale? A seller sounds like would prefer a share sale. They would prefer to claim the lifetime capital gains exemption, but a buyer may prefer an asset sale.
Yeah, so buyers often do prefer asset sales, and that's really because they can be picky. They can choose what they're buying. They can also avoid some historical liabilities and potentially benefit from a higher tax cost base than the assets, which really equals an opportunity for bigger depreciation deductions going forward. But on the flip side, they usually have to pay a bit of a higher price to make it worthwhile for the seller. So sellers, on the other hand, they love share sales because they're simpler, they're cleaner transactions, they're more tax efficient. And of course, as we've discussed, the biggest attraction is the LCGE. On top of that, you're handing over liabilities, you're moving on in a clean fashion. But of course, the buyer's concern is that they're inheriting the liabilities, and that's why careful negotiation is really paramount.
Yeah, I guess two offers aren't necessarily equal, and if you're budgeting for how much money you're going to get and what you can do with it, there's tax implications to take into account. And I think particularly important for financial planning, especially retirement planning. So if I'm a business owner and I'm planning to retire, how does the sale of my company fit into my retirement strategy?
That's such a fantastic question because the sale is often the largest single source of retirement funding for entrepreneurs. And so they need to understand how that fits into the big pictures. And And it's risky to ignore the other elements of your financial plan and just hang your hat on this one event. So the other elements of your financial plan being RSPs, TFSAs, and even non-registered savings, we see these components as really being interrelated versus independent of one another. And these different elements can really come together nicely to build your tax efficient retirement income strategy. That's incredibly desirable. I meet with a lot of people who say to me, they've been receiving compensation from the business for years, drawing a salary, drawing dividends, and then all of a sudden, this event happens and they need to know, like, where's the money going to come from to fund our living expenses, to fund our lifestyle. I've even had one client say to me, like, how do I go to the store and buy groceries? Which sounds funny,
It's true though.
but yeah, exactly. So I think it's so critical to have the ability to map out everything all in one place so that we can then understand, okay, how do those holding company or holdco withdrawals, taxable and tax-free dividends come together with other sources of income in order to meet your needs. And of course, estate planning is also part of this process, making sure that those intentions are reflected in your plan.
You mentioned RSPs and TFSAs and building up savings and other areas. I think sometimes it can be tempting for a business owner who knows their business and feels confident in their business to continually reinvest, but there's some diversification benefits, tax benefits to
Right.
utilizing RFPs and TFSAs as well. Really important. You did mention, Nancy, holdco. I find sometimes that's a term that people are not necessarily familiar with. So,
Right.
what's a holdco?
A holdco is really just a corporation. And what happens is that some business owners who have profits that they don't need to run their business or they don't need for personal spending or saving, they might decide to set up a holding company. So as I mentioned, it's a separate company and it's really set up so that profit can be moved over from the operating company on a tax deferred basis. Setting up a holdco really accomplishes a couple of main things. So one, it keeps corporate investments away from the main business. And two, it helps qualify for the lifetime capital gains exemption. It helps in that purification process that we talked about earlier.
Not having too much in your main corporation you're
Right,
operating.
which could then disqualify the business as a QSBC. So, and ultimately, it also helps keep your precious retirement savings that you worked your entire life for away from creditors. Um, Worth noting that obviously it does mean extra accounting and legal fees because it's a separate corporation. You now need to file annual tax returns, T2 returns, but it can be well worth it.
So what if somebody isn't sure about the value of their business? Some people have got a rough estimate. Some businesses are more, uh, I guess easier to value. But how does somebody figure it out whether they're just planning ahead or they're actually getting to the point where they are starting the process to find a buyer and they're trying to figure out what a fair value is?
Great question. What I found in my experience is that sometimes accountants are willing to weigh in on what they feel is a reasonable evaluation. But other times people will use chartered business valuators or CBVs who can provide an independent valuation that really manages expectations and it helps support the negotiation process ultimately. Costs could be about $5,000 or more, just depending on the complexity of the business. And really, the role of a business broker is quite important because they're not only coming up with that valuation figure, but they're also marketing your business for you. They're finding buyers, they're qualifying buyers, and their end goal is to maximize that sale price. And so together, they can really help sellers achieve a fair value and have a smoother transaction process. Their fees are typically anywhere between 5% to 10% of the sale proceeds, depending on the value. And there also could be a minimum dollar value, like 50,000 to 100,000 or so. These are all considerations.
So I guess a business broker may not be suitable for a business that might only be worth a couple $100,000. You might need to
Exactly.
have a more valuable business. It's interesting. I think to a certain extent, it's helpful to get a professional opinion as well. You may have a sense of what you think your business is worth, but it's good to know what it might actually be worth from the perspective of a professional. Sometimes you need to get a business value done because you're engaging in other transactions, and for tax purposes, you might need a valuation, but different situations where you might need to have some professional input.
Exactly. Especially since they're providing that assistance along the way. They're not just coming up with the value, but they're helping the whole transaction process.
One thing that business owners struggle with generally, I find, is, should I make RSP contributions? Should I make TFSA contributions?
Right.
And sometimes people might wonder, this tax hit potentially from selling my business, regardless of how I sell it. Like, should I keep RSP room if I'm planning to sell my business? Should I use that RSP room when that big transaction happens?
Well, I would say it really depends. It's case dependent. It's not black and white. So, for example, if you're confident that you'll use the lifetime capital gains exemption and have millions sheltered tax free, then obviously RSPs may be less critical. But if you're building up corporate savings and just ignoring RSP room, then potentially that could be a missed opportunity. And the reason for that is that using RSPs can provide you with added flexibility. So, for example, it's possible future governments could change the rules on the lifetime capital gains exemption, which would then make the whole event way more onerous from a tax perspective. And so with proper RSP planning, really works well for smoothing out taxable income in retirement. And so you see that, yeah, this is really not an either or, but it's really a question of a balance. And that's really what a lot of the modeling work that we do can help accomplish. Is it can help us better understand what role RSP planning has in your particular financial plan.
I think a lot of times we find that making RSP contributions or TFSA contributions, if somebody has the funds building up inside their business, is advantageous. But like you said, it depends. And these are things you can work on mathematically when you're doing long-term financial planning projections.
Exactly. And just like you said earlier, I mean, I think that ability to diversify in terms of your investment asset. Yeah, I think there's something to be said for that because, again, governments could change the rules when it comes to taxation, corporately speaking. It almost happened before, and it's possible. So it's obviously to your benefit to have greater flexibility through these various investment vehicles.
Yeah, the proposed capital gains change
That's what I'm talking about. Yeah, exactly.
Didn't come to fruition, but could have led to a lot more tax for people building up investments inside their corporation. And when someone is building up investments inside their corporation, sometimes they might wonder, what if I've got personal debt? If I've got a mortgage, should I be focusing on paying down that mortgage more aggressively, taking out more salary or more dividends, or should I invest in my holding company? So just wondering if you've got an opinion on that.
For sure. Actually, I get that question a fair amount, I would say. And it depends on two things. It comes down, I think, to your comfort level and also cash flow. So from a numbers perspective, if your holdco investments earn more than your mortgage rate after tax, then investing may actually make more sense versus debt repayment. It also depends on your personal tax rate to take extra corporate withdrawals because obviously there's a hit there as well from a tax perspective. We also find that there's obviously soft factors or a psychological aspect to all of this because for many clients going into retirement mortgage free, well, it just takes a weight off, right? And it gives them that peace of mind. So they, forget about the numbers. They just would rather pay down debt than invest. And I would say too, the other thought is, the business sale gives you a chance to settle debt and start retirement on a clean slate. So those who are planning to sell may hold off paying down their mortgage as aggressively, and they may choose to invest instead.
You've got this big inflow coming in, right? At some point, hopefully.
But no matter what, our role, my role as a planner is really to also look at those corporate attributes and those notional balances within the corporation to review whether there are tax-free or tax-efficient ways to draw funds from the corporation. So I call that, the low-hanging fruit. If there are some ways that you can withdraw money tax-free, then let's look at them and consider repaying some of that debt.
And just going back to holding companies, and when we're talking about building up investments inside a corporation, and oftentimes it is a holding company for reasons that we referred to previously. But if you end up retired with an investment holding company, or even an operating company that is no longer operating, in which you've built up investments, how do corporate investments fit in with retirement planning after a business sale or after a retirement?
Well, I would say, that many business owners use a holdco to obviously grow their retained earnings as well as invest proceeds from the sale potentially. So this can provide, corporations are great vehicles because they can provide tax deferral, but also control over how and when the income is drawn. So that's, for example, unlike an RSP, which must be converted to a RIF by the time you're 71, and that first withdrawal has to happen at age 72. So with the corporation, we get, we have more flexibility. And so I'd say therein lies that planning nuance, is how to draw from the whole code efficiently, mixing salary, dividends, and capital gains while coordinating on the personal side with personal accounts, especially as it relates to retirement spending. And that's really where ongoing and annual tax planning and cash flow planning become very critical.
I find it's interesting. Some people don't know that they can keep their corporation open after they
Right.
retire. I've heard that one before. Or,
Yeah.
even in extreme cases, they don't realize they can open an investment account for a corporation. They're just building up cash or otherwise taking it out personally. And then a lot of people just don't know how it works. Like, when I retire, how do I get money out of my corporation? How do I pay myself? What are the tax implications? All really important aspects of planning.
I was just thinking, especially as it relates to what's happening in their lives on the personal side from day to day. So what is the debt situation? What are the annual expenses? But not only the annual expenses, but extraordinary expenses. I find people often forget. Oh, yeah, we have to purchase the
New
car. We were going to do
cars,
that renovation.
gifting to
Um,
kids.
Exactly. So planning helps us kind of look around the corner, right? To match up those expenses with tax efficient cash flow sources, which may include corporate with, dividend withdrawals.
I like that expression, looking around the corner. And sometimes, you know, business owners that are working with an accountant who may be great at what they do and with the tax planning. And I mean, you're looking 1 year behind. You're not looking around the corner, and you're certainly not looking way off into the future. And if you're looking ultimately in the very long run, to the end, so to speak, and we're talking about estate planning considerations, what are some of the things that people should be thinking about when selling a business from an estate planning perspective?
Well, I find this one often gets missed, to be honest. If you sell in your lifetime, then obviously you'll need to decide how to use those proceeds, what you're spending, investing, gifting, donating, figures will look like. If you plan to pass your business on to children, sometimes the succession planning goes in that direction. Well, then there are special rollover rules that may defer tax. Post sale, I think it's a huge opportunity to sit back and say, okay, once the dust settles, then, let's revisit, let's look at our wills again. Let's look at the possibility of setting up trusts either during our lifetime or testamentary trusts, charitable giving strategies. And as I mentioned, too often, I think people get wrapped up with the whole transaction and living life and how are we going to pay the bills, that they kind of forget the estate planning piece.
I think it might be helpful, just as we're getting close to the end of our discussion here, to try to map things out. I know that you've got a comparison table that you've built to summarize some of the main differences between a share and an asset sale. Like we've talked about it a little bit, but if we're really breaking it down, what are those main differences, Nancy?
So really, just by way of recap, we have here the differences between a share sale and an asset sale. In the case of an asset sale, this is really preferred by buyers. They like it because they get to be choosy about which assets they actually end up buying. They get to avoid liabilities. There's a tax piece too that works to their benefit, and that is that there's a step up in the adjusted cost basis that could result in a bigger depreciation later on. On the flip side, a share sale may actually be preferential for the seller. And the big carrot there is the lifetime capital gains exemption. Sellers want to ensure that their shares potentially qualify as QSBC shares and tap in, perhaps even multiplying the LCGE exemption, which we talked about as being 1.2 up to 1.25 million per person. It's a very clean transfer, I'd say, because really the buyer is just stepping into the shoes of the seller. They're becoming the new shareholder. And for this reason, it's generally preferred by the seller. Either way, whether it's a share sale or an asset sale, then I would say that planning is obviously imperative. You want to start these conversations early on. And it's even possible, might be a consideration to actually think about having this modeled from a financial planning standpoint. Do a scenario, have your financial planner do a scenario where they look at an asset sale and another scenario where they look at what a share sale would potentially look like and walk through those different tax implications because as we've talked about, they are different. When it comes, to an asset sale, we talked about the capital gain being in the corporation and the corporation pays the tax. And then if you want to draw that money out, well, then you're going to pay tax on the personal side. And for a share sale, then that's a personal sale of shares. And obviously we're looking for the LCGE to apply and that huge taxable piece there where hopefully the gain will not be taxable as long as it's under 1.25 million.
There's benefits to planning ahead, certainly from a tax and a legal perspective, but also a financial planning perspective. And even after the dust settles, I feel like there's an ongoing need for financial planning. Like you said, how do you pay the groceries? Where do you get your cash flow from? What's the best way to accumulate your assets? What are some of the mistakes that I should be avoiding? And a lot of times that's what planners help with. And if we're trying to identify for people who are listening in top mistakes to avoid, specifically when selling your company, what would you say some of those mistakes are to look out for?
Mistake number one at the top of the list is just waiting too long. So starting 3 to 5 years in advance to allow for purification of shares, restructuring if necessary, and retirement planning would really be a good idea. Number two, not checking into LCGE eligibility, that lifetime capital gains exemption eligibility, or those QSBC rules. So missing out on this opportunity can cost literally hundreds of thousands of dollars. Point number three, I would say, top mistake number three is ignoring retirement integration, just kind of looking at everything on a piecemeal basis. Don't assume that the sale alone will fund your lifestyle. Map out all of those income sources, including, the potential use of an RSP, TFSA, and then, of course, integrated with holding company withdrawals. The fourth mistake that I often see is just overlooking liabilities and due diligence. So in a share sale, buyers really need to be rigorous, have that due diligence process in place, ensure that there are protective clauses. Sellers should factor liability exposure into retirement security as well. And number 5 would be skipping professional advice. So I think it's really important not to try to do it all yourself. Let the professionals do their job. And so having a strong team, and I do say team because everyone is specialized in their particular role. You need an accountant, you need a lawyer, but the role of a planner would really be more of a quarterback role or holistic role to put together all of the moving parts of your financial plan and ensure that your tax, legal, and financial planning are really all pointing for the best possible outcome. Another mistake I often see is not stress testing your numbers. So sometimes I find clients will either overestimate or wildly underestimate. And so expense, if you do that when it comes to your expenses, and this can really derail retirement, model conservative and optimistic scenarios is really the way to go. Overestimating value or underestimating the business valuation is also a key mistake that I see made. Number 7, neglecting estate planning. So sale proceeds should really be aligned with wills, trusts, and charitable giving, as we discussed.
It's almost like a financial reset to an extent that you need to take a look at your overall situation. There's life events like, getting married, having a child, starting a business, selling a business, retiring. But financial planning can and, ideally should be an ongoing exercise. And, this has been a really fantastic look at some of the things that business owners should be considering as part of their long-term planning, Nancy. So just wanted to thank you so much for adding depth to this conversation that I'm sure listeners really appreciate.
My pleasure, Jason. I really hope it gives business owners the confidence to prepare early and also holistically.
To everyone listening, and remember, this isn't just about taxes, lifetime capital gains exemption we talked about, in particular, big tax opportunity, really is important stuff. But selling your company is a chance to fund and secure your retirement and financial independence, plan early, get professional advice from multiple sources because it's a truly multidisciplinary situation. Thanks again, Nancy, for joining us. And for anyone interested, we will include Nancy's contact information in just a minute for you to reach out with any questions or comments. Thanks very much for joining us, Nancy, and thank you to everyone for listening in.